Right, today we're going to look at aspect of the market dynamics, or how to conceptualize and understand the massive activity in the market, how to just make sense of it all. We need to make sense of the market. On Friday, we did a webinar. We had about 200 traders in there, and between those traders, we came up with. Now, we would expect most retail traders are losing. Very statistic. How much time? I've actually had two traders contact me telling me they've been trying to trade for 20 years. That's a huge amount of time committed. How many people, listen, they would be happy if they trying to figure this out in 10. I know that some of you here will have been looking at trading for 10 years and break that cycle. Because you're not breaking that cycle, without realizing many of you are actually repeating the same mistakes over and over again. Not actually to blame for this cycle. But the retail education world is much selling you. A retail trader decides they want to trade, they go looking, show me how to trade this. Let me watch you trade. Don't buy a method, and it doesn't work, and there's absolutely nothing. Got no background of that method to change or improve upon. So they go look for another technique, basically the same as starting again. Okay, so a typical retail trader decides to trade, and he just wants to know, where do I get in? He doesn't want to know how the market works. Now, if you take a professional trader in a proprietary trading firm, what they will do there is they will first teach their intern traders how the market behaves. Now, typically 25% of the program in a prop firm is teaching. 75% is guided observation, where the student is given exercises and drills that reveal how the market behaves. So students see this for themselves. Then they're given really suggestions, but not rules on how to exploit the behaviors they've seen. After 12 weeks, they're left to show that they can profit on sim before they're given a live account to trade. So the faster guys, they're trading live real money as soon as the 12-week training period is over. The slower guys will take a little bit longer. So it's just 3 weeks of theory, 9 weeks of guided observation, and then a variable amount of practice. Now, their technique is based on an understanding of market behavior. And if the technique doesn't work, the trader has this knowledge of market behavior to lean on and figure out, is the market behaving differently? Is my technique wrong? Or is it just poor execution skills? And then we can repair what's broken. So today, what we're going to focus on is the behavior part, how the markets behave and why. So you need to understand this to break the cycle that many of you are in. After all, as the last presenter said, if you keep what you're doing now, you will keep getting what you're getting now. So let's go back to your first day of trading when you decided to look at this giant pool of easy money and make yourself a fortune. So let's say on that day, you met a wise old trader and they told you nobody knows where the market will reverse. Now, how would that have changed the way you approach the markets personally? Well, for many traders, it would have been a big change. Instead of trying to buy the lows and sell the highs, they would have been following moves that had already initiated. If you couldn't tell where a market would reverse, then you'd have to make money some other way. Now, whether this is true or not, really isn't related to fundamental analysis or technical analysis. It's sort of a level above that. It's almost a philosophical question. Now, how would we know if this statement was true or not? Well, we'd need to understand how markets behave, and trading is all about understanding how a market behaves and then trying to exploit that behavior. But what does that really mean, how the market behaves? In fact, what is a market? And we're going to answer those questions today. Now, a big part of trading with confidence is understanding whether a trade makes sense and whether the trade you're in is really working out or not. And many people try to do this with statistics, trying to figure out the amount of time something occurred before in the hope that this will be relevant in the future. I'm going to commit trading heresy here and suggest that statistics are actually of limited use. And to back that up, I'll just ask you a simple question. You don't have to answer it. The question is, do you trade statistically yourself? I mean, can your own personal behavior be modeled mathematically? Will you personally trade predictably and according to a rigid mathematical model if you just lost money, or you just made money, or you had an argument with your husband or wife, or you've got a hangover, or any range of different things that can affect you? And the answer is probably not. Now, I'm not saying there's no place for statistics in trading, but I find it odd that the people believe the market's going to conform rigidly to a statistical model, while at the same time knowing that they don't do that themselves. Okay, so I don't think it's a question of statistics are bad, that we can't model trading behavior in various ways. I just think there's a more organic side to trading that really gets overlooked, and this side of trading is just as important as the technical side. Now, we need to have a model or a philosophy that explains why moves occur in the market in the first place, why people buy and why people sell, but from a human perspective, not a mathematical one. And today, we're going to look at my philosophy or my belief system when it comes to the markets, my take on that organic side of the market. Now, what I do think is true is that if you don't have a way to perceive this huge mass of traders, that a purely mathematical approach will leave you at a huge disadvantage. Now let's consider how complex this kind of worldview or philosophy of the markets needs to be. So we all know the markets are very complex places. In any market, we're going to have institutional long-term investors, we'll have hedgers, swing traders, day traders, HFTs, and algorithms all participating. Markets affect other markets at a macroeconomic level, like interest rates, currency rates, and oil prices. We have technically related markets like NASDAQ, Dow, and S&P 500, or Brent crude and WTI. And all of that complexity is really daunting. Do you actually need to understand it all? Can you trade without knowing what an HFT did in the past 20 nanoseconds? Does your statistical model need to take into account all of these variables? Well, how about if we just take a step back and consider what the result of all this complexity is? And the result of all that complexity is simply up or down. Despite all that complexity, markets can only go up or down. In fact, if you toss a coin to enter a trade, you'll be right about the market half the time. Now, random trading would still lose because of the spreads and the fees. It'd be a slow bleed. But a lot of traders don't even have a win rate that's equivalent to random trading. They aren't anywhere near that successful. And there's a few reasons that many traders can't get close to random trading results, and we're going to look at that as we go. But the bottom line is that the market is very complex, but the result of trading is actually quite simple, up or down. That's all we can do. Now, based on the complexity of the market and the number of people involved, we can see how terms like crowd psychology are used when it comes to describing the market. And there's two issues with this term and others like it when applied to the markets. First of all, there is not a crowd. There are many different crowds. So on crude, you have people trading outright positions, calendar spreads, people spreading Brent and WTI, and these different groups have different goals and seek different outcomes. So it's hard to see how they could really be considered part of the same crowd. The game they're playing is so different. Another issue with the term crowd psychology when it comes to trading is there's plenty of people talking about it, explaining that, crowd behavior moves the markets, but then there's no bridge between that knowledge and how to trade the crowd behavior. We don't hear much advice on how to use crowd behavior information to enter and exit the markets when that's actually what we need to do. So it's knowledge without much practical value. So let's try and give that some value today. So let's first consider something I call the dominant crowd. Now, it's my belief in trading, and I'm going to back this up later, that we have multiple layers of crowds, but that only one crowd can be dominant at any time. Now, I don't use the word in control because I don't really buy the idea that the markets are controlled at all. So the dominant crowd can be considered the crowd that is influencing market direction the most at this point in time, but it shouldn't be considered in control of the market. Now, with the futures markets I trade, I just consider 3 potential dominant crowds, and you could break this down slightly differently if you like. This is what I find convenient. So the first dominant crowd, potential dominant crowd, is long-term institutions, and most of the time they are asleep, or rather they aren't dominant most of the time because they're playing a long-term game, so they're not changing their mind and switching positions often. So it often takes major economic news for institutional trading to come in and dominate an entire market. Now, we often get alerted to long-term institutional positioning with planned or unplanned news releases. And that positioning tends to create directional moves, and often those moves are actually quite hard to join in. Now, the other crowd I look at is short-term speculators. People like you, people like me, that are in the market to make a short-term dollar. People that really aren't interested in underlying value rising, but just trying to make money from movements in the markets. And in the markets I trade, this is the dominant crowd most of the time. Now, the third set of people, market makers and manipulators, they tend not to be dominant unless the market is very quiet, at which point the opportunities for them to make low risk profit increases. Now, I lump in manipulators here because manipulation is basically more likely and safer to do in a quiet market. Now, if you ever saw your market move one way all day and you kept trying to trade against it, or you just couldn't join in the move, that is simply you not reacting to a change in the dominant crowd. Because if long-term institutions become dominant, they will not behave like day traders. They won't react because of a short-term move in the same way that day traders would. It wouldn't make any sense for them to do that. And that's why one-way days are often quite hard to join, because it's a different market and traders try and apply unsuitable techniques. Now, the moves generated by these crowd are different for a couple of reasons. First of all, the time between them buying and selling are different. And second, the sort of moves or events that cause those traders to react are also different. So hedgers and spreaders, people who trade multi-instrument markets, they're unique in that they don't generally care what happens on one side of their trade. So if you trade a single market, buy high, buy low, sell high, you're going to react to events in that market. If you trade a spread, events on one side or one market in your spread aren't important. Now, a move against a spreader on one leg of the spread is irrelevant. That's why spreaders generally aren't here as being part of the dominant crowd. Their trading is not directional. Now, there are exceptions to this, but best not to complicate things. Now, with HFTs, they're also not here as the dominant crowd. So their holding times are so short that they also won't be dominant. Their buys and sells are so close to each other that they're basically cancelling each other out. So chasing HFTs, not really beneficial. Now, if you're going to trade the markets, you need to set goals. Now, what would be a reasonable goal when it comes to benefiting from the dominant crowd? And I don't mean percentage return, I mean a goal from an individual trade that you're planning to take. So how about this for a goal? I want to buy the S&P 500 futures tomorrow with a 4-tick stop and hold the trade for 12 months. Now, I think we all know that wouldn't work, and it's an obvious example, but let's consider a less obvious example. I want to buy the low of the day on the S&P 500 futures tomorrow and hold till the high of the day, because that's what a lot of traders are trying to do. And I can't tell you it's right or wrong, but what I can tell you is that if it doesn't fit in with your understanding of how the markets work, then of course it will not work. So for me, it has to fit in with my understanding of the dominant crowd and how that behaves. And with that, I can validate my goal and validate my trades, and I can also stick to it under pressure. Now, I also know that I need to have different goals depending on who the dominant crowd is. So with my understanding of the dominant crowd, I now need to understand crowd dynamics or crowd behavior to understand how that crowd can behave and how to exploit it. Not in a theoretical sense, in a practical where to get in, where to get out sense. So here we have a chart, and as you can see, it's a pretty empty chart. It's a typical day. I know I'm a day trader. This stuff does apply to all forms of trading, but we're going to stick to day trading today. So this is a day ahead of us, a day where we have little information other than any levels we might have set before the market opens, and some scenarios we think that may play out. Many traders set levels before the day starts, and it doesn't matter really what market we're talking about here. All that matters is that we're going to trade, we haven't started yet, and we have some levels of interest. Now, on this example day, we'll have day time frame speculators the dominant crowd, just because they are most often. And at this point, the vast majority of day time frame speculators are not positioned yet, because the day hasn't started yet. They're not in the market. Now, some common levels of interest are noted here, and different markets have different levels of interest. This is just an example. And experience tells us that when day time frame speculators are dominant, we're going to have a number of candidates for where the market might react, where the high and the low might be, or it might just react in the middle of nowhere. So these levels are simply potential crowd reaction points. And then our day opens. Now, some levels we can define before the market opens. Some will be created based on the activity after the open, and a lot of this is to do with fairly basic psychology. So people win money, people lose money. Losers tend to be wary of making the same trade again, at least in the short term. And when people see that one side is clearly winning, they're going to join that and ride that move. Now, the open price is significant as it tends to bring us back to unchanged for the day, and it's only going to be relevant to short-term players. Institutional investors are not going to change their mind about a long-term trade that they made on that day if we go back to the open price. So we keep this on our radar because it's a potential crowd reaction point. So we have kind of preparation or homework-based reaction points that we create before the open, and we have developing action-based reaction points or potential reaction points. And then we get a move. Now, we've moved through a common level here, and we're now basically at another common level. So in terms of the crowd, as we move up, we're going to see there are a lot more buy market orders than sell market orders. We'll also see that the large trades are mostly on the buy side. And as this move up continues, what is it your average retail trader is trying to do? Well, many are watching the market move up, waiting to sell it. Now, that's despite the fact that this market has upside momentum, and despite the fact that order flow and the crowd are clearly favoring the upside. Retail traders want to sell, and there's a few reasons for this. First of all, these well-defined levels are indeed places the market could reverse, and there's an assumption that this makes levels the best places to take a trade. Okay, and that assumption is one I've never seen proven. So let's, for now, be skeptical that you should be trading at your levels, but we should also all be able to agree that the level isn't the only place you can enter. So you can use levels for many things, and trade entry is just one of them. Now, levels do in theory give you the most points per trade because you stand to benefit from the whole move if you trade at the extreme. So a single reversal trade gives theoretically more points or more ticks than a single continuation trade, but that does not mean you'll make more money trading reversals because there are less reversal trades available. And reversal trades are also attractive because they have a very clear get out point. So if you sold the market here, you can put your stop just up here, and it looks a lot cleaner, but it's just an optical illusion because the markets can only go up or down from any price point. And that's true regardless of whether you enter at a potential extreme or you enter in the middle of a move. So what is the smart money doing during this move? Well, on the way up here, you'll see trades over and over again, mostly on the buy side, 20s and up on crude oil, 100s and up on the S&P 500. And there are people that say the smart money is just the people that bought at the start of a move. Okay, some educators call these start of move prices wholesale prices, and that anything after the turn is a retail price, and only bad traders to pay retail prices, that the pros pay wholesale. And in my opinion, that is total nonsense. After all, 100-lot traders clearly know what they're doing, right? It's not somebody's cat going over the keyboard. So a move like this would not occur unless there was a significant amount of buying on the way up. If the smart money only bought the bottom of the move, that would mean it's just small, stupid traders buying afterwards. And if that was really the case, there wouldn't be a move up. I'll repeat that. If there wasn't serious commitment to the upside with big, large lot traders, we would not continue the move up. And you can see this yourself. Pull up a tape. have a look at the size of trades during a move and ask yourself, is that all dumb money? Because it really doesn't make any sense. So when momentum is to the upside, there are very smart short-term traders buying and making the most of that move up. The people losing out are the ones who keep selling it, or the ones who keep watching it go up and not participating. Now let's consider how this works from a crowd behavior perspective. So we can observe that smart money doesn't just buy the extremes of a move, and we've also discussed having an organic view of the market to complement your technical and fundamental views is a smart thing to do. And you can't get much more organic than sheep, which we know move in herds. Now, the people that buy at the low of a reversal up are basically the first few sheep to take steps in a new direction from the herd. Other sheep see them move and then decide to move with them. And before you know it, all of the sheep are heading in that direction. And it's not a bad thing to be a sheep. They move in herds, so they don't get picked off by a wolf. It's safer to move in a herd. The sheep that follow aren't the dumb sheep. They're moving with safety, not wanting to get left standing on their own. It's the sheep that don't follow that get eaten. So if your organic view of the market fits the sort of herd behavior we see in sheep, and you think about how and why sheep move, it doesn't seem that smart to always try to be the first sheep to move in a new direction. Now, a lot of the times, a few sheep will move out of the herd and none will follow. And we have a few in the bottom right, we have a few counter-trend sheep here fading the herd. But the chances of them successfully swinging the herd their way at this point is close to zero. So these are the counter-trend sheep that in a clear move up keep trying to sell the market. Now, the sheep analogy for the trading crowd is a lot closer to the truth than this idea of wholesale and retail prices, which just falls apart when you consider the size being traded during a momentum move. And it makes a lot of sense when you watch the order flow too and see how real size is trading a move up. Okay, so back to our day, and our day moves on a little bit and we get what appears to be a turn, or it could be a pullback. Which is it? Do we know? Is this the first few sheep going against the whole herd, or is it a new move initiating? Now, before we answer that, it's worth having a think about why pullbacks occur, or why sometimes we might actually need a pullback. So in a move up, we have sheep initiating long positions, but these sheep are not buyers. They've already bought. So they are now future sellers. So we have a combination of two things occurring. On the way up, more and more of the sheep have already built a position the size they're comfortable with and don't want to buy anymore. And also, some of the sheep start to offload and take profits. So we get a little bit of an imbalance and we get a push down. And when that occurs, one of two things will happen. After a small amount of selling, market moves back up and the sheep quickly re-engage on the long side. So we've managed to shake off a bunch of future sellers, stale longs. People can see the pullback held, and sheep see the safety of the herd is on the long side. The long trade is now the one that will attract the most sheep. Or alternatively, more and more sheep sell, and this selling gathers steam and it continues until the sellers overwhelm any remaining buyers. More and more sheep see this and believe now the short-term opportunity is to the downside. The herd has shifted. And as traders, we're watching this play out. Just like all those sheep, we're trying to assess the movement of the herd. Now, it's common for traders, I'm pretty much sure everybody in this room does this, it's common for traders to see themselves as one thing and the market as another. So almost like you're the climber and the market is the mountain. Now, what's a little bit harder to conceptualize is that traders, we are simply just another sheep in the herd. You're a sheep, I'm a sheep, other traders are sheep, the algorithm's a sheep. So you and the market are exactly the same thing. So when you think about what's the market going to do, it's what are you and everybody else going to do? And as traders, we have to accept that the market is simply made up of lots of participants trying to figure out what everybody else is going to do, either short term or long term. And it is that process, everybody trying to guess what everyone else is going to do, that actually creates the moves in the markets. Okay, there is not this the market entity that's creating moves. It's just everybody trying to guess what everybody else does, and it's a bit, makes your head spin a little bit. So there is no the market. There's just lots of people and machines all trying to take advantage of each other. Now, as we discussed earlier, if I told you I could give you a precise mathematical formula that would predict where you personally would buy and sell today, you would say you're crazy, okay? Because you don't even know where you're going to trade today, right? Most days you sit down, you don't know what's going to happen, you don't know where you're going to get in and out. But many people want to believe that a mathematical formula can predict whether some of all participants will change direction on any given day. Now, considering you're a trader, how is that mathematics figuring out what you're going to do exactly? How is it predicting your own personal behavior? So let's presume for a second that nobody knows where the market's going to turn around. And let's not even accept it. Let's just embrace it, that we don't know where the market will turn and that nobody else does either, because it's all sheep and there are simply too many sheep and too many variables. Now, what does that mean? It doesn't mean that we've made trading more difficult. It just changes how we make money from the market. It's just a slightly different mindset. So where do levels come in? Okay, so we know a lot of people, they like to use technical analysis, set levels. It doesn't mean we have to throw the levels away. A good level is one that is well known. Okay, so if you go onto some trading website tomorrow and you see something that says we've got this super secret level, you can have a good laugh at that, because if a level's not well known, not many sheep are going to react at that level. And even with well-known levels, the sheep may ignore it this time, but take notice next time. It's just pretty random. But what we do know is this: when a market reverses off a well-known level, the sheep are more comfortable going with that move. And this is where levels actually help you. A move away from a level is more likely to continue than a move out of nowhere. It helps with bias. So levels are great, absolutely fantastic. But trying to enter the market as a reversal trader exactly at your levels and expecting the market to reverse there, give you a 10, 20, 40, 50 tick trade, it's just not high probability. And I know a lot of you are trying to do this and not realizing that's the problem you're having. Now, you can still get a very, very good trade if you don't trade at the level. But why do you need to trade at the exact turning point? Why do you need to be the first sheep? If you're a sheep, would you be the first sheep? Okay, there's no upside. You do get potentially more profit on an individual winning trade, but you're going to have bigger and more frequent losers. And this is what many retail traders are doing. They're trying to predict where the crowd will turn. And professional traders don't do that at all. They simply trade what is happening right now. So when you try to trade a major turn, you are always trading against momentum. You're trading against the market. Market's moving one way. You're trying to predict a sudden mass change of mind. You don't just have to be right. You have to be right now. Now, at some point, we need to confirm that any counter trend move is a reversal or not. If it is, then there should be some activity from the sheep telling us that this is a counter trend move, this is a reversal. So on a reversal down, market sellers should outnumber buyers. Volume on the push down will be relatively high. We'll have more sheep. And the size of the push down will be greater than any pullbacks on the way up for that day. In other words, we're going to see a decent push down with good participation. That's what you want to see to say this market has now moved. And this is, of course, if the day time frame speculators are the dominant crowd. Until these things happen, though, you have to be careful trading a reversal. You might just be seeing a few wayward sheep. Now, where levels really help is when a reversal occurs near a well-known level, it just tends to attract more sheep. It helps you confirm direction has changed. So back to our example. We're now back to the open price, another potential reversal point, okay? Or in my opinion, another place where a bounce could bring in sheep. So once again, let's just go through this. Is this high the only place in the move down where the smart money entered? Okay, is this the only wholesale price and all these prices on the way down are just dumb retail prices? If so, who are all the people throwing the 100 lot orders on the S&P 500, 20, 30 lot orders on crude on the way down here? They're just like dumb people with lots of money. And if we enter long now, what's the chance we'll get trampled by sheep? So if you think of the market as a herd of sheep, you think about exploiting different market behaviors. The hard strategy is always going to be being the first sheep, because quite often you'll be out there in front, you'll look behind, and nobody's following you. Being the lead sheep, it's enticing. Everybody wants to do it because you get to enter one of these nice turns and put your stop above it. Okay. Being a follower sheep means entering in the middle with momentum. And the thing is, there are many, many more momentum opportunities, the reversal opportunities on any day, week, month, or year. There's no concept of, oh, I've missed the turn, so I've missed the trade. And when you think of the market as a herd of sheep, you are actually embracing uncertainty, and the markets are uncertain places. You can still have your levels, but you don't need them to hold to the tick. They're simply potential reaction points. And when a move's underway, you see small pullbacks, iceberg orders, high volume nodes, lots of little different pointers that give you the opportunity to enter as long as the sheep are still on your side. Now, sure, these might be new locations or might be new things to look at to your average candlestick trader, but they are not that hard to spot. So how do we prove that this English guy with a strange accent is not just talking nonsense? And here's how. This is a typical end of day picture. Now note, I'm 12 hours ahead of Eastern time. This is 9th of March 2017, and it's the crude market. And the day speculators were the dominant crowd on this day. So we saw short-term speculation drove the market one way, and then it drove back up the other. The market actually closed very, very close to where it opened. Okay, now it can't be that market fundamentals were driving this. You know, this wasn't major institutions having a bit of a mood swing at lunchtime. This is absolutely intraday speculation. Now the reversal here from short to long was kicked off with a big swing up. We could call it this one or this one. Big swing up in the delta here, and then a big swing up in price, and that's the herd really turning around. Now the most likely scenario for any day is that it's going to swing up and down as a result of short-term speculation. So even if you look at the market overall and think the market's moving up, it's still going to give you long and short opportunities on 90% of days in the process, and you're going to see that over and over again. But the actual turning points, they're just a bit fuzzy, because the markets are so huge and complex and organic. And if it all seems like it's a bit too much to take in, a bit too vague, just take a deep breath and remember, it can only go up or down. Now, searching for something that works for 10, 15 or 20 years is absolutely a soul-destroying experience. I know when I hear from traders who have been trying to trade 20 years, it saddens me, you know, all the other things they could have been doing. And most retail traders, they just want to be given a few simple rules they can trade forever, right? They don't want to work at it, right? And the problem is they just keep looking and looking and looking for those rules that don't exist. They don't want to work at it, but they end up spending 20 years. And to me, that is working at it. So what traders want is to be given a few simple rules. What traders need is to know how the markets behave, and then they can start to exploit that behavior. So traders that understand how the markets behave evolve with the markets. Traders that want to buy trading rules just simply bounce from one system to the next until they either give up or look back and they've got 20 years in the bank. Now, what we've discussed today, you're going to say, well, that looks difficult, but it's not really about easy or difficult. It is simply about having a different perspective of the markets. In many ways, it's really just about stop fighting the market and go with the flow, go with the path of least resistance. Now, Jigsaw, we focus on giving you tools and training to ensure that you can understand, observe, and exploit these market behaviors. And we do, of course, discuss many trade setups, but always making sure we explain why the opportunity exists, what behavior you're exploiting, and why it works. In other words, we help you break that cycle of just looking from one system to another system to another system. And not only that, our tools are actually inexpensive. So our training material is free. There's at least 15 hours of trading material you can go and watch this afternoon on our website. It's absolutely free, nothing to sign up for. And we also offer a 14-day, no questions asked, money back guarantee. So there's literally no risk in signing up. And for the next 24 hours, we give you a little bit of a sweetener, and we give you 10% off the price of a license for the Jigsaw tools. And again, I say there's absolutely no risk. If you don't like it, just come and ask for your money back. So there's no risk in signing up. And I think you should all join up and actually start to break that cycle, because your biggest risk right now in the market is actually spending thousands of hours and thousands of dollars on systems that keep you detached from the truth of the market.